for short sale. Now in short sale, you see a time T0, the investor will borrow the stock. Investor borrow the stock, and then they sell this stock immediately to the market and collect the money back. Okay, and at time T1, the investor will buy back the stock and repay the stock to the securities company, and they take the profit if the market price decrease. Then the short sale. So in short sale, the securities company also require investor have the initial margin. Okay, for example, if initial margin is 60%, so you should put 60% value of the stock in your account, money. Your initial margin will be money. Now, for example, you borrow 1,000 stock X from the securities company, and the current price of the stock X is $25. 25. It is $25. Okay, it is the current price of the stock X. You borrow 1,000 stock X. Remember, in short sale, you borrow stock. You don't borrow money, you borrow stock. Okay, now if the initial margin is 60%, so it means the securities company require you to put 60% of 1,000 multiply $25 in your account. So it means your initial margin will be 60% multiply 1,000 multiply 25. So how much it is? It is $15, right? So it's your money. It's your money, and you have to put it in your account. Okay, so it is initial margin. And in this case, your debt will be 1,000 stock. And the securities company also determine the maintenance margin. For example, it is 30 or 35%. It depends on the securities company. Now, so in short sale, how to calculate the current margin? In short sale, how to calculate the current margin? The current margin equal to your equity minus your debt divided to the market value of the stock. We have the same formula. You take what you have minus what you borrow and divided to the market value of the stock. Okay. Now, however, in short sale, what is your equity? In short sale, what is your equity, or what do we have? What do we have in this case? Or what is your equity? In a stock, you sell it. Now, when you borrow stock from the company, you sell it immediately to the market. So you don't hold the stock. Your equity is not a stock. Now, what do you have? You have, when you sell the stock, you collect how much? When you sell the stock, you collect $25,000. You sell 1,000 stock to the market at the price $25. So you collect $25,000. Okay, so the current margin equal to the profit you collect from selling stock. So your initial profit plus what? Plus this one. It is the initial margin. It's the money you put in your account. So is it your money? Okay, so you plus your initial margin here and minus debt. Now what is your debt? What is your debt in sales? You borrow what?
Borrow stock.
Yeah, you borrow stock, and the value of the stock depends on the market price. Okay, minus value of the stock. This one should be the current market, the current market value of the stock. And divided to the market value of the stock. Yeah. So the formula to determine the current margin in sales. Okay. So now let's practice. Determine the current margin if the price, the market price is $35, and we calculate if the price is $15. Now calculate the current margin. Now, if the price is 35, so what is the current margin? We have the current margin equal to what is the profit? Profit is 25,000, right? What is your initial margin? It's 15,000, right? And what is your debt? Minus 1,000 multiply 35 and divided to
1,000 multiply 35.
Yeah, 1,000 multiply 35. 1,000 multiply 35. Now what is your answer? What is the answer here? Now calculate it.
0.14.
Sorry?
0.14.
0.14.
Yes.
Okay. So you see it's 14%. Because you see the market price increase. When the market price increase, so investor will take loss in short sale. If the market price decrease, investor take profit. However, in this case, the market price increase, the investor take loss. So you see the current margin decreased to 14%. Now, in this case, if the maintenance margin investor, the securities company determine is 35%, you see investor will receive what? Margin call. Yeah. In this case, investor will receive margin call because the current margin is smaller than the maintenance margin. Okay, so now recalculate if the market price is 15. Recalculate. So we have this one is 25,000 plus 15,000 minus 1,000 multiply 15. And this one is 1,000 multiply 15. So what is the answer? What is the result?
$1.60.
1.6?
Yes.
Okay, so it's 160%. It's increased too much. So you see, if you saw sold and the market price decrease, so your current margin increase, you take profit. Okay, you got it? Any questions? Any question here, class? Do you understand?
Yes.
Mm-hmm.